You're listening to Frontier Matters, the podcast from 1914 Reader. Join us as we dive into bold conversations on growth and change in the frontier economies of the world.
Our guest today needs no introduction. 1 year ago, we asked him what he thought was happening in the Nigerian economy. And at the end of that conversation, we promised to compare notes again in a year. So today, through to a word, we brought him back to mark his own homework. A lot has happened since then. Markets have rallied, investment sentiment has shifted, and there have been significant developments across power, energy, and infrastructure. So this is kind of like an opportunity to revisit some of the arguments and predictions he made, ask what has changed, and find out whether his optimism has translated into something real for investors, businesses, and the wider economy. Happy to welcome back a friend of the house, Fola Fagbule. Welcome to Frontier Matters.
Hi, Faye. Hi, Toby. How you guys doing? Good to be here again.
Hi.
Good.
Hi, Fola. Welcome.
Welcome back. Okay, cool. Let's start with my first question. So basically, when we spoke last year, you said things are looking up and that there was a very healthy pipeline of opportunities. 1 year on, how do you think that call has aged? What are the things that have translated into actual commitments and financial closes, and which parts are still just conversations in the pipeline?
Thanks, Faye. I think the call has that call aged quite well. So quite a few major transactions have closed in the last 12 months since we spoke, including at least one really large deal that is still closing and I can't speak about yet. But if you think about it, you'll know which one I'm talking about. But it's already safe to say that 2026 would be a banner year for corporate finance in Nigeria, just in terms of transaction volumes. Since we spoke this time last year, FID has been taking on more than $3 billion in upstream oil and gas projects, including landmark announcements that you would have seen from IOCs like Shell and ExxonMobil. Fingers crossed, we will probably still have the largest IPO in African history this year. That's the Dangote Refinery IPO, much talked about. And that will be a quite transformational transaction for the Nigerian securities market. There are several other projects, maybe not as prominent, in the oil, gas, and mining space that are all closing away from the headlines. Many others continue to make progress as well. So each of these transactions already in their own ways having catalytic impacts on aggregate demand, productivity, export volumes, and value chain complexity in key sectors. So the deal flow is getting better all of the time. So I think the call aged quite well. I would say one more thing. The area of concern really for me is around diversification and deepening of transactions that are closing across sectors that have a greater impact on job creation. So if you think about what has happened in the last 6 months with the war in Iran and the resulting global trade crisis, I think it's not unusual that deal volumes have slowed down quite significantly globally, and also in Africa and in Nigeria as well. It's not an exception to that. So it's not as good as we would need it to be for the kind of job creation that we're trying to achieve. But that's where we are.
Yeah, I mean, you sort of prefaced the next question. The headline capital flow numbers appear to support, some of your optimism a year ago. Foreign capital entry in Nigeria rose from $12.3 billion in 2024 to a little over $23 billion in 2025. But about 85% of that, which I'm sure you're aware, is portfolio investment, which brings up this FPI versus FDI debate. So I'm wondering what you think would need to happen for all this money chasing yields and financial assets to become long-term capital for factories, infrastructure, and basically jobs, like you said.
I would say, first of all, close to $1 billion in the officially recorded FDI into Nigeria is a great result compared to the years that immediately preceded 2025. So, when you say only 923 million, I would be cautious with saying that it's actually quite significant relative to where we're coming from. Also, the doubling of foreign capital inflows is a remarkable statistic in that same context, that doubling. So I think that you find that 2026 will probably be an even better year, given the deal flow, as I talked about earlier, which again, as I said, is remarkable given the global context that we are operating in. The other thing is to say, look, FDI is not necessarily it's important not to conflate it with the investment appetite that is happening in the country, particularly investment appetite in the kinds of job creating projects that we're all keen to see. So, FDI is not necessarily the best measure of that kind of appetite in the country. And we're seeing that increasingly that appetite is actually dominated by local investors. And not just in the securities markets, where it's well recorded that domestic demand is the primary driver, but also in terms of longer term investments, where domestic operators are becoming the most important players in various sectors. So if you think about major capital investments by Dangote, Seplat, Aradel, Boa, MTN, Airtel, many other listed companies that don't show up in the FDI numbers, my estimates of Q1 2026 capital expenditure by the top 10 listed industrial companies on the NGX is about $780 million, just Q1, and just the top 10 industrial companies. And this is all based on their interim reported financials. So that gives you a sense of the scale of investment that is going on that doesn't get captured in FDI numbers. There's also capital investment by major non-listed companies that doesn't show up in FDI, including outlays that are being made as we speak to build the largest petroleum refining complex in the world by Dangote in Lagos. Now, to your second point about capital chasing financial assets versus sort of real sector assets, I come from it from the perspective that in the end, all assets are financial assets. Market appetites will find expression in whichever pockets of value exist in an economy. The nature and perhaps the real issue that we're experiencing is that Nigeria has just gone through one of the biggest demand shocks in the history of the country. And there's been a major reduction in purchasing power on account of the currency devaluation that has happened. If you then add the energy price shock from the US-Iran war, the closing of the Strait of Hormuz, it's not surprising that a lot of capital is chasing assets that are export-facing, where Nigeria has some competitive advantages, and hence fertilizer, refined petroleum. That's where a lot of the capital is being directed towards. In the long term, challenge is twofold: increasing the number of sectors where we have these kinds of competitive advantages for export trade, and then also restoring domestic consumer demand on a sustainable basis. And that's ultimately where this job-creating businesses of the future will come from. Those will be the main drivers of that kind of growth.
Okay. I think let's talk about a topical issue now that has been in the news lately. On the 10th of July, the NGX cited I think Bloomberg carried a report with data showing that Nigerian equities had returned 67% in dollar terms this year, making Nigeria the best performing stock market among the 92 markets they tracked. Stable Naira and financial services stocks have clearly contributed. But what do you think is fundamentally driving this rally? Is it principally an earnings story or just a macroeconomic re-rating of Nigeria? Or is it domestic liquidity? I think something you've hinted at already, looking for a home or momentum, and how much can really be inferred about the state of the wider economy from the performance of the stock market?
So, I think asset prices have essentially undergone an upwards reset in local currency terms following the devaluation. Or to put it another way, to go back to business school language, the present value of future cash flows to be earned in Naira by many of these listed companies has become more valuable given the greater stability of the currency. And the market is looking out at a future in which the currency is more stable. That makes a lot of these companies more valuable than they historically were thought to be. So for a while there was a once in a lifetime opportunity to purchase shares at effectively rock bottom prices in hard currency terms. And so there's a lot of that has happened, that sort of re-rating to that reality. There's also an aspect that is about domestic liquidity, a lot of which was previously cautious or was parked in hard currency, for fear of the devaluation that was imminent, that is now finding expression in opportunities that are presented by the market. So there's also an aspect, I would say, that is about the underlying growth in many companies, which continues to happen in Nigeria, despite the various challenges that we're facing. For the economy itself versus the market, I would say it remains in the early stages of a recovery. There's still a long way to go, but it's not unusual that financial markets are a leading rather than a lagging indicator. So there's some of that we're also seeing.
At the end of our last conversation, again, to follow up on Faye's question, when, I think it was Faye that asked you if you have a hypothetical $1 million to invest in Nigeria, I think your answer was around export-linked assets were the best edge, and mentioned companies like Seplat, Aradel. You also favored businesses able to price at import parity, such as Dangote Cement and Presco. So I'm curious, will you still make that investment in the same way today? Or where has the margin of safety moved, in your view?
When I was preparing for this, I went back and listened to our earlier conversation again. And then I noted the companies that we discussed in the podcast. So if you look at the stock prices of all the companies we discussed last year, you may be interested to learn that an equal weighted portfolio made up of those names would have returned about 116% in Naira terms and about 140% in US dollar terms, without accounting for dividends. So that 1 million is now about $2.4 million. So that's the first thing. Having said that,
I hope some listeners invested last year. Please send your 10% here.
But having said that, look, the world has changed today from what it was 12 months ago. I would say certain fundamentals still remain the same when it comes to Nigerian equities. Personally, my investment horizon is very long term. And in my view, still businesses like the ones we talked about the last time, they remain the most optimal way to gain exposure to Nigerian equities without taking really undue risks. These are large, well-capitalized companies that, they are very unlikely to go out of business, and they're going to benefit from much of the growth that will happen in the country. That being said, the margin of safety is probably less than it was 12 months ago, given that stocks have run up so much in that time. But fundamentally, the universe of companies doesn't really change much. I think those are still some of the names to back in Nigeria.
I mean, last year another thing you talked about was that the transmission mechanism between fiscal policy and development outcomes was badly broken. We all know that. We can all see that. And that Nigeria did not really have a functional budget. Again, this was something we dug deep into, and been proven in many ways lately, and even over time. The government now describes the economy as being in a consolidation phase, but public debt was put at 152 trillion in January, and debt service is projected to absorb nearly half of the government revenues in 2026. Has anything happened over the past year that makes you a bit more confident about the fiscal credibility and budget execution of the government?
I think we've all seen what has happened. I think you were alluding to this a bit, what has happened with the lack of a functional budget since we spoke the last time, how problematic it has become, just like we discussed and, what we were expecting it to be. Perhaps this even played a role in the most significant cabinet reshuffle that the government has undertaken with the change in the coordinating Minister of the Economy and Minister of Finance. You may also have seen that IMF has publicly commented on the issue, which has dragged it even further into the spotlight. So if it was not an important issue for the government 1 year ago, it is definitely very high on the agenda now. It must be, given the attention that it is getting, including even in the National Assembly, where there has been a lot of attention to this matter. Has anything happened over the past year that makes me more confident about fiscal credibility and budget execution? I think the new Minister of Finance clearly understands the problem. My understanding is that there is a clear effort that is underway to begin to put an end to that chaos of the past and establish a stronger footing going forward. What needs to be done is clear. I don't think there's anything ambiguous about what needs to be done. We need to design and implement a functional budget in 2027. So that's a budget that is anchored on realistic estimates of revenue and expenditure and actually reflects the actions that the government will take during that year, rather than being a wish list or a box checking exercise. So whether that will happen or not, I think the jury is out, and we'll see how the new minister proceeds.
Let me push you a little bit on that point, if you don't mind. I recall that one of the worries you also expressed last year, or perhaps area you think deserves more attention in that conversation, was this question of state capacity. And I think it also feeds into the bureaucratic capacity to deliver some of these reforms. So when you look at some of the budgeting, quote and unquote scandal, and some of it, you find that some of the process is pedestrian, undeserving of what I would say a country like Nigeria. And also on the question of, say, more synergy or coordination in terms of policy making. I mean, you have a situation where the budget ministry writes numbers and the finance ministry is supposed to find money, and things like that. Do you think the government has done enough in terms of how the bureaucracy delivers reforms generally?
I mean, I think that's a general problem across everything that Nigeria is dealing with. So it's not, specific to the budget. It's not specific to security, for example, nor is it specific to electricity, which we're also going to talk about. This issue of state capacity and the ability of, even if you have the highest level of political will and you have the highest amount of talent at the most important and most senior levels of government, and they had the best intentions and the best will to implement those intentions, would you be able to still achieve the results? Because the capacity is really just not there. So that's a problem. That's sort of the sky falls down all of us type of problem that exists across various areas. But I don't think that it's a reason why you cannot have a functional budget. We have had functional budgets in many recent years in Nigeria, in our lifetime, even when state capacity was a problem. So I don't think that, the lack of state capacity is the reason why the budget has not been functional in the past. I think that we can have a functional budget in spite of that issue.
Okay. Let's move to the power question.
I think I wanted to say something that, I mean, my theory about this budget issue is that the problem actually began in 2014. So if you recall that August 2014 was when oil prices crashed. So, we had, was it 4 or 5 years of $100 oil per barrel? And then August 2014, everything just crashed down to $30. And I think at that time, the government took the approach that, you'll go back up, So no change was made. Nothing was done to say, this might be the new reality. And then you start having this thing build up over time and here we are 12 years later, where that gap between, what is written on the page and what is reality has just widened beyond any, 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 where any reasonable person can tolerate. But anyway, that was just my
Yeah, no,
speculation. Yeah.
that is true. I think that's part of it. It's a problem that has progressively worsened over many, many years. The truth of the matter is some of the levers that needed to be pulled in order to be able to address it have since been pulled. So, for example, the currency has been devalued, fuel subsidies have been taken away. So, these are the levers that were required to be pulled in order to then have a budget that is functional. So there's really no excuse now to not have a functional budget.
Yeah. So, I mean, let's talk about one of your favorite sectors, power. You estimated last year that settlements across the electricity value chain could amount to $10-15 billion, and one that a problem of that scale had to be approved very carefully. Soon after we spoke, I don't know, incidentally or deliberately, the government approved up to 4 trillion naira of debt refinancing. 5 claims were later settled at 3.3 trillion naira, with over 500 billion raised. Yet, by February, our plants were receiving only about 43% of the gas they required, and the national grid, has fallen to roughly 4,300 megawatts. It's always national grid failure every day on Twitter. How should we distinguish a genuine financial reset from simply moving old losses onto sovereign balance sheets? What are the structural conditions that must accompany the government's attempt to bail out or financially sanitize the sector?
Yeah, so thanks, Toby. And this one I have to be careful what I say, because this is a transaction that AFC were very privileged to have been involved in advising the federal government on how the transaction was implemented. So I have to speak only about what is in the public domain. The government themselves, they've said, look, restoring liquidity to the power sector value chain is critical. So they recognize that. And this transaction was an extremely important first step to begin that process. It's a transaction that was a landmark transaction in many ways, very difficult to accomplish, but with a strong effort by lots of really dedicated people, much was achieved. Now, a core part of our advice to the government in implementing the transaction was about providing a roadmap and putting solutions on the table to ensure that we don't have a repeat of this type of situation again in the future. So part of the resolution is in trying to avoid a repeat of the situation in future. And there was a clear roadmap of things that needed to be done. So it doesn't end with this. There is the next step and the next step and the next step that gets us to a position where you finally have a self-sustaining electricity sector that can cover its own obligations as and when due. There's now a presidential task force that's been established, and they have the responsibility to make all of this happen. I don't think there's any lack of understanding amongst the leadership about what needs to be done. The devil is always in the detail, but I'll say executive summary of it is there are clear measures that must be taken to create an industry that pays for itself sustainably, where the government itself does what it says it will do, and all the other participants in the value chain are incentivized to honor their own obligations with no delays. So this is the only way that an electricity market functions anywhere in the world. It's not a Nigerian thing. And so Nigeria is not going to be an exception to this rule. We have to be able to make the market function the way it is meant to function. And then the problem will cease to occur.
Okay. Another thing you also said was that renewables were a quote-unquote quick win, and you argued that Nigeria should triple down on them, and even said you will subsidize renewable energy as much as possible. 1 year on, do you still think rooftop, off-grid, and other distributed systems are the fastest route to materially cheaper and more reliable power, which is obviously what anyone is trying to get to for Nigeria, or do the attempts to scale them eventually run into the same topic you've just discussed now, the same financing, regulatory, and all those grid constraints as the conventional electricity system that we already have in place?
I mean, this is one I think where you and I have a very healthy difference of opinion. But I think first of all, just some numbers that have recently been put out there. I think it was the managing director of the Rural Electrification Agency who recently said that Nigeria has recorded 837 megawatts of solar capacity imports in 2025 versus 375 megawatts in the previous year. So that's imports of solar electricity capacity in 2025 versus the previous year, 837 megawatts. So if those numbers are accurate, that's quite remarkable relative to a total available grid capacity that you pointed out of 4,300 megawatts. That's almost 10%, approaching 10% of the total grid capacity in 1 year was imported as solar capacity. Now, I expect that this trend will continue simply because solar technology is becoming cheaper and more widely available at a much faster rate than the grid itself. So it's simply a question of the supply meeting demand in the marketplace. So there's clearly demand for energy, and this is the supply that is meeting that demand fast enough. It's a dynamic reality that, anyone that is working on grid systems anywhere in the world has to deal with, is this issue of solar capacity coming into a market. So in Nigeria, for the folks who are working on grid capacity design and planning, they must also contend with this. I don't think we have the luxury of imagining a world without a significant contribution from off-grid solar to the electricity needs of Nigeria. I think that ship has really sailed already. And it's just a question now of what other solutions can we bring to the table in addition to off-grid solar, because it's already happening.
Yeah, I mean, to be honest, I admit that I've lost this battle. Everyone knows my opinion on rooftop solar, not grid solar, just rooftop solar, because of the long-term problems I think about how it rules out the corporation, the building of a grid, and even investability, because I'm not quite sure, how anybody is going to invest say $1 billion in power generation in Nigeria if there's just so much energy already on people's rooftops. How do you reconcile? But anyway, so I've lost that battle, I accept, and I think this train is a very, very fast moving train. I mean, somebody went to, I think it was Ikiti recently. A friend, he went to Ikiti recently and said he was actually quite surprised at how much solar there was everywhere, right? Little shops, big houses, small houses, everywhere. Everyone had some kind of solar solution going on. So yeah, so I think, I agree with you that, it's a dynamic reality, like you said, if you want to call it that.
Yeah. I mean, to your point about,
I'm still on the energy market.
Sorry,
Yeah.
Toby, to the
Go
point
on
on how is $1 billion of investment going to happen in electricity in Nigeria? I think this is a very important question that goes to not just Nigeria, but also many African countries. Why are the utilities not bankable? Why are they not able to support significant amounts of capital? Well, because the level of industrialization is so low. And a huge amount of the demand for electricity is industrial demand in any normal functioning system, any normal functioning grid. A significant amount of the demand is coming from industrial users. when the level of industrialization is so low in an economy relative to the population, relative to the human demand, the consumer demand for energy, then you don't have that source of revenues coming into the electricity market. And that's part of the reason why we are dealing with these challenges.
So, I mean, staying with the energy market, you predicted a wave of financing opportunity in the pipeline on the Dangote refinery, investment in depots, jetty, downstream distribution, etc. The refinery has since become fully operational and processed 700,000 barrels a day during a performance test, while substantially expanding exports. But I mean, as you can see, Nigeria has also discovered that the fact that you make something locally will not make it cheap. And in this case, domestic refining does not automatically mean cheap fuel. What has the past year taught us about the difference between local refining, energy security, and lower consumer prices?
I think we're learning some very hard lessons in the Nigerian energy market, some very painful lessons. And I think that I wish the lessons were less painful for the average consumer and also better managed and communicated by the government. But we're where we are. It's a point I've always tried to make in conversations with people in Nigeria about the energy markets, which is to say there's really no relationship between domestic refining capacity and cheap petroleum products. This is a relationship that Nigerians seem to have built into their minds and into their beliefs about domestic refining capacity. It's become almost a matter of faith, almost like religious belief that, if you have domestic refining capacity, then you will also have cheap petroleum products. Energy costs are influenced by global factors beyond the control of any government anywhere in the world. Nigeria is not an exception to that, although we pretended to be for decades at great cost to the country. Now, energy security is a different matter entirely. And one of the lessons, a very positive lesson that I think we have learned from the war in Iran and the closure of the Strait of Hormuz, is that you just cannot do away with energy security as a consideration. Without Dangote refinery being in operations, I'm sure you're both aware of this. The last 6 months would have been close to apocalyptic for Nigeria and for many countries in Africa in terms of disruptions to fuel supplies. So supplies that simply would not have been there if that refinery was not operating and producing petroleum products. So that is the energy security point, but it's an entirely different thing from low consumer prices. And that's really what domestic refining capacity does for you, is that energy security.
Do you still think? Do you think that do you think that there's a chance, or are you seeing any signs of a like an ancillary industry starting to form around the refinery? I mean, stuff that you mentioned last, things like the depots, jetties, downstream. I mean, what I've heard, and this is just anecdotally, what I've heard is that there's been a complete reordering of that old industry. So the jetties, the tank farms, for example, they're pretty much all gone now. Are you seeing things replacing them? Are you seeing new stuff, new industries just forming around the refinery? Or what are the signs you're seeing?
I think we're still at the very early stages of a mega trend as far as domestic refining capacity in West Africa is concerned, with Nigeria being at the helm of that. And it really is a mega trend where I think this one single reality of a significant player in the market has shocked an entire industry into life. So I think that you will see a lot of investments in refining capacity, more investments in refining capacity, just from the point of view of people that are trying to establish independence, commercial independence, to be able to compete and operate in the market. So I think that wave will happen. I think there's already some of that kind of activity that folks are doing, and that's where a lot of the initial financing will go in the early stages of the trend. Inevitably, there is still the question of, how do you get the product to consumers cheaper? And that's where pipelines and storage facilities and what have you come in. And that's still yet to come. I think right now is just where day one of the mega trend, really, as far as domestic refining capacity is concerned.
Yeah, I mean, one of the things you said last year was that it was inevitable that Nigeria will use gas to industrialize. I mean, this is the point you were talking about just now about industrialization in Africa, Nigeria in general, and in particular, and that the government first had to stop. You said the government had to stop the economy from drowning before it could pursue a coherent long-term energy strategy. So crude production has now reached its highest level since April 2020, so 6 years, and ExxonMobil and its partners have committed $1 billion to the Usan infill project, which is kind of like a really big deal because, Exxon haven't put any major money in Nigerian oil and gas in a while, so are we finally moving from the survival phase into that longer term strategy? Or is the renewed upstream momentum still primarily an export and government revenue story rather than the foundation of a modern domestic industrial economy?
Yeah, I think it's, again, even in this regard, it's still early days in the story. I think much of the industry is focused on increasing output. You have new indigenous operators that have taken over from the former IOC owners. So names like Renaissance, Aradel, Seplat itself is part of that trend. And all of these guys are focused very much on mobilizing capital to increase their reserves and grow their production, grow their earnings. And that trend, I think, will continue in terms of crude production volumes. Now, in relation to gas, which is what your question is about, I still think, and maybe this is the optimist in me, but I think it's backed very much by facts on the ground, that it is inevitable that Nigeria must use its gas resources to drive industrial development. I'll tell you one reason why I believe this. I think there are some lessons that are being learned from the success of the Dangote refinery and fertilizer project, in the sense of how it has transformed a country almost overnight from an mere exporter of crude oil into an important global refining and petrochemicals hub. And that lesson is reverberating, I think, across the highest levels of business, finance, and government in the country. And people are seeing what happens when you go from simply exporting a raw product to when you add value to it, what happens on so many levels in an economy. And so I believe, and in fact, major investments in the gas space to do something similar in the area of gas processing are already ongoing. And there are other investors that are in the wings and preparing themselves to do the same. So I think you're going to see a significant volume of investment that is around gas, gas monetization, gas processing, gas transportation, gas as a feedstock for petrochemicals, gas for electric power, and other sort of industrial operations in Nigeria. And then you will also see a lot of the follow-on opportunities in the downstream value chain that come from this. So maybe it's optimism, but it's backed by some evidence.
Sorry, a quick question, just a side question.
Yeah.
What is going on with the Bua refinery? I know I mean, do you have any information? It could be public information, but I've just not checked. But in terms of, obviously I think there's a 200,000 barrel per day refinery that's supposed to be going up in Akwa Ibom, that sort of thing. Do you think that the success of the Dangote refinery as a huge, big one would it encourage more refineries, or would others just say, okay, I'm just leave this thing for him?
So again, that one I would rather not speak about because I'm working on. But that is one example of a project that is out there that is a follow-on opportunity, part of that whole mega trend. But that's just one example. There are many others, including at much smaller scale, where in order to maintain commercial independence, people are realizing that if you want to remain in this business, you must have your own product to sell. So that will drive a certain amount of investment activity. And then you will also see something similar in gas, I believe.
I mean, I imagine that a year from now, we would also like to catch up on the conversation we are having today. And I mean, a lot would have happened. We would have had an election, and hopefully the transition goes well, whoever wins. What is or let me not say one, what are the predictions you are prepared to make about the Nigeria economy a year from now? And what indicators should we watch to know whether the country is moving into sustained investment-led growth?
So it's to be honest, it's difficult to make predictions about the future. Certainly in Nigeria, where things are known to change quite dramatically. But everything being equal, based on all of the information that is available to us today, I think there's a lot more positives than negatives in terms of the trajectory. I think the worst of it is probably behind us. I think that there are global factors beyond the control of anybody in Nigeria that, I think you may also agree, that have huge implications for what things look like in Nigeria as well in 12 months' time. So what's the situation with the global energy markets? What's the situation with the war in Iran? What is the situation with trade wars across the globe? What's this? Hopefully we're not in major conflict. Even more so than the world is today. And those are the factors I think that really will determine where we are. But overall, and thinking about the things that are within the control of Nigeria as a country, I would say we're in a good position relative to where we were 24, 36 months ago.
All right, one last question. A bit of a personal note for you. Obviously, it's been publicly announced that you're going to head out AFC in East Africa. What are you looking to achieve in terms of? I mean, the issues around intra-Africa trade are well known. It's difficult to travel on the continent. Countries don't do as much business with each other as they do with external parties, that sort of thing. In your own little way, what are you hoping to achieve in that role in terms of, even if it's just a kind of connection between West Africa and East Africa, maybe deepen those connections, that sort of thing? What are the ways in which you're looking to maybe make a mark, however little, in terms of that in this area?
Well, hopefully it will be a very big mark rather than a little one. But East Central Africa is really one of the most dynamic opportunity areas on the continent at the moment, and in many ways. So if you look at demographic trends, if you look at the evolution of the governments and the quality of governance in several of those countries, If you and the evolution of the quality of that governance has mostly been positive evolution. If you look at the ambition of many of the governments, what they are trying to accomplish, if you look at the level of talent in the economy, the young people, the ambition that they have, what they're hoping to achieve, and then if you come to the natural resources that are present, that are the critical minerals that are very important for that the whole world is interested in for growth and development and electrification. So the region is on the cusp of quite significant growth. We have achieved a lot of success already there. I think the task for me is to take that potential and take the successes that have been achieved in the past and say, how do we build on this? How do we do projects that are even bigger, more meaningful, more impactful? How do we go beyond projects to really helping to alter the ecosystems positively so that it is possible for significant development to happen? In terms of integration with the rest of the continent, there is some of that is happening already. There is a lot of that can still happen. One of the kinds of integration that we're most keen on is sort of moving capital from where it is surplus to places where it is scarce. That's something that on a Pan-African basis has not happened. Intermediating capital between capital surplus and capital scarce regions of the continent is not something that has happened significantly in the history of the continent for many, many reasons, not least because a lot of the decision-making and capital allocation was happening outside of the continent. So we now have the infrastructure, if you like, to be able to do that. To mobilize capital from one part of the continent and deploy it in another part of the continent. We have a shareholding structure that reflects exactly that, with shareholders that include some of the most important pension funds in East Africa becoming part of the equity of AFC. Some of the funds that we manage, mobilizing capital from different parts of the continent, investing in other parts of the continent. So it's really about taking that integration to the next level. So integration in capital, integration in skills, in partnerships. We know so many successful projects and entrepreneurs that we've worked with in one part of Africa. We take them and work with them again in another part of Africa. This is a very common theme in what we do. So you saw, for example, a very prominent example, but there are many, many, many other examples. But a very obvious example is working with Dangote, Aliko Dangote, on a refinery in East Africa, following his success with his refinery in Nigeria. We had also, prior to that, invested in refinery in Angola, refinery in Cote d'Ivoire, refinery in Senegal, in Cameroon. So we have a lot of experience with refining capacity. So we'll take that experience and go and use it in East Africa as well, hopefully successfully. So that's the kind of transfer that we can immediately do. We don't have to wait for any laws, any policies to make those type of things happen. And those are the areas where we hope to make a significant mark in a very short period of time.
Great. Looking forward to that and wishing you success out there. Thank you once again. It's been a pleasure having you again to look back on, things we spoke about last day and also to look forward. So hopefully we'll see you again soon. Thank you.
Inshallah. Thank you very much.
All right.
Thank you, Fola.
Okay.